If you got some money you're sitting on right now, I would buy your mutual fund. Like tomorrow, according to Dave Ramsey. If you have money you need to invest today, do you remember the aftermath of the 2008 financial crisis? That period marked by uncertainty eventually led to one of the most significant bull markets in history. Fast forward to today, and we're standing at a similar point in time, with the S&P 500 hitting record highs and indicating a strong year ahead. A recent article from Reuters perfectly captured this feeling by showing how the S&P 500 has risen to levels that have never been seen before, driven by hopes for lower interest rates and strong growth. Meanwhile, Goldman Sachs research is forecasting a 6% return for the S&P 500 in 2024, suggesting that despite high equity valuations, the market still holds promising opportunities for investors. These insights set a compelling stage for our discussion today. We're going to talk in detail about why 2024 is not just another year but a huge chance for investors. These insights come from Dave Ramsey's advice and are backed up by solid research. We will talk about what this means for your portfolio, why you might need to act right away, and how to make smart investment choices this year. Ready? Let's get started. Alright. Let's break this down so it's super clear, especially if you're new to all this stock market stuff. The S&P 500 hitting record highs is big news, and here's why it matters to you even if you're not a Wall Street expert. So what is the S&P 500? Imagine it as a giant scoreboard that tracks how 500 big companies in the US are doing. When the score goes up, it means on average these companies are doing well. Recently, this scoreboard hit its highest number ever at 48,398. This isn't just a random high score, it's like a signal flare saying, hey, things are looking up here. You might be thinking, okay, but why does this high score matter? History gives us some major clues. After really tough times like the 2008 financial crisis, when the economy took a major hit, the S&P 500 started climbing and kept going up a lot. It went up over 400% by 2020. That's like turning $1 into $5 over those 5 years. When we see the S&P 500 reaching new highs, it suggests we might be at the start of another period where things keep getting better for a while. Now let's sprinkle in some facts. Research shows that in the years when the S&P 500 sets new records, the return, or the money you make on your investment, is usually around 10 to 15%. That's pretty good considering the average savings account gives you way less than 1% over long periods. The S&P 500 has provided significant returns to investors, for example, from its inception in 1928 through the end of 2023. The S&P 500 has returned an average annualized return of about 10.26% since adopting 500 stocks into the index in 1957. This includes periods of both record highs and lows, reflecting the market's cyclical nature. Investing in the S&P 500 during years of record highs can be seen as an optimistic bet on the continued growth of the US economy and its largest companies. While past performance is not indicative of future results, the historical average annual returns suggest that the stock market over time has trended upwards, rewarding long-term investors. But what's pushing the score up, you might ask? It's not just one or two things, it's a bunch of factors. Lately, technology and artificial intelligence have been big players. It's not about making quick money on a trend. Actually, these tech advances are altering how we live and work, and they are supporting the market rise. Economically, things are looking a bit brighter to inflation, which is when prices for stuff we buy go up, is starting to chill out. The Federal Reserve, which is like the economy's thermostat, is hinting that they might not hike up interest rates much more. This is good news for the market because high interest rates can slow things down. What does this mean for people who are thinking about investing this high? School on the S&P 500 is like a green light saying it's a pretty good time to start. The market's momentum and solid ground of tech growth are like a double thumbs up for investing now. In simple terms, if you've been waiting for a sign to get started with investing, this is it. The market's showing signs of strength, and there are opportunities out there for the taking. Remember, investing is about the long game, and right now the game looks promising. Let's look at some historical moments and what they teach us about seizing opportunities in times of uncertainty. Firstly, consider tech bubble burst at the start of the millennium. It was a tough time for investors, with the S&P 500 plummeting by almost 50% from its peak in 2000 to its trough in 2002. Yet those who stayed invested or entered the market at low points saw substantial gains in the following years. By mid-2007, the S&P 500 had recovered all of its losses and reached new highs. This cycle of decline and recovery emphasizes the importance of patience and long-term thinking in investing. Fast forward to the 2008 financial crisis, another pivotal moment for investors. The S&P 500 fell by over 56% from its high in October 2007 to its low in March 2009. However, the subsequent recovery was remarkable. By 2013, the index had doubled from its 201 lows, and by 2020, despite the COVID-19 pandemic's impact, it had more than quadrupled. Investors who recognize the cyclical nature of the market and invested during those downturns often reap significant rewards. These historical instances highlight not just the resilience of the market but also the opportunities that downturns can present. They teach us that while the market's short-term movements can be volatile and unpredictable, its long-term trajectory has been upward for investors. This shows how important it is to stay informed, be patient, and keep a long-term view, especially when the market is volatile. Dave Ramsey is pretty clear on this. If you've got some extra cash, it's smart to start investing it right away. You might be wondering, should I wait for something big like the presidential election to happen first? Well, history shows us that waiting around for the perfect moment usually means you'll miss out on some good opportunities to grow your money. And this is what Dave Ramsey has to say about this specific concern: waiting until after the presidential election in November to do your investing. That's probably a dumb idea right now, and if you're thinking about pulling all your money out because you saw some headlines, don't do that either. Yeah, we found that if you just ride this roller coaster, over time you're going to hit a new record high and a new record high and those, and then it's going to go down, and then it's going to come up, and then it's going to go down, and then it's going to come up. This is how life works. Here's